So you are listening to the Monday edition of the On the Tape podcast. I am Dan Nathan. I'm joined in studio by Liz Young. Guy, that would be
EY from SoFi. We're rolling. I mean, this is a Monday. A little misty out there. Little misty.
It's a little misty. So summer's ending, if you guys got the memo here a little bit. It just feels like it's getting a little crisp in the morning, a little crisp at night. Liz and I bumped into Liz on the beach over the weekend. Yes. A beach that you had bumped
into.
Same
Same beach we bumped into each other on, Guy.
It's crazy.
Yeah.
What are the chances?
We won't dox Liz, though. All right. But this is the
Liz
Monday edition. And on the Monday edition, we kind of do a quick look back of some of the exciting things that might have happened on Friday when you did not catch us on the air over the weekend. And then we also do a little bit of a look ahead. I actually had a great conversation. I don't know why I said actually. I really did have a great I don't know why I said really. I had a great conversation
you were involved.
with Chad Anderson, who is the founding and managing partner at Space Capital. Guy, you've spoken to Chad Anderson in the past.
I did.
He's also
I actually was on a panel. I moderated a panel. So wait for it, Elizabeth.
You did your joke. You did the thing with the space joke, the space movie joke, the ET thing that you mix up with 2001.
Probably.
Yeah.
Well, I mean, I love that whole genre of movies. But Elizabeth, get ready for this.
What?
I guess one could say that Dan was hanging with Chad.
See what he did there? All right, but really quickly, we had a great conversation. He has a early stage venture firm investing in the space ecosystem. He wrote a book, The Space Economy, and it's not just sci-fi stuff. It's basically everyday products that we use and how they're interacting with the space economy. And it was actually a fascinating conversation. The book's fascinating. We're actually going to do a giveaway for the book, the first 100 listeners who leave a review for the On the Tape podcast and the OK Computer podcast, because that conversation is going to be up on there. Take a screenshot of those, email them to contact@riskreversal.com, bug the heck out of AD, that would be Amanda Diaz, okay? And you'll get a copy of Chad's book. It was a great conversation. All right, guys, gal, this weekend, it was all about Jackson Hole, what was said, what was not said, but what was very clear was the messaging that rates are going to stay higher for longer. That doesn't come as a big surprise for us. But the fact of the matter is that, we've talked a lot about those 2022 inflation readings. We talked about where the CPI is right now. We talked about the fact last week, we spent some time talking about even a 3% is on top of the, high single digits that we had in 2022. But Bloomberg has this as the post-inflation challenges vex central bankers. They're terribly vexed, Liz.
What does vexed mean?
Well, vexed, if you guys remember the 2000 classic guy, Gladiator, and you probably watched this because it was meant to take place in your Rome, in Rome, Italy, back in the day. But you remember the scene where Commodus, who is the, just kind of the really difficult kind of Caesar there, he says, "I'm vexed. I'm terribly vexed." He was really pissed off about this, about something that happened here. Probably wasn't about inflation. No. So Liz, talk to us. Are you vexed by inflation and what needs to be done to continue to battle it and get it down to central bankers' targets?
No, I'm not vexed. First of all, isn't Guy Sicilian? Not.
Well, he's half Sicilian.
Thank you, Elizabeth. Can I tell you something? How long have we been together now? I mean, the fact that you said that is it's wonderful.
Yeah.
That you have acknowledged that there actually is. There's a separation. There's a differentiation. So thank you.
You're welcome. You're welcome. No, I am not vexed by inflation. I think, Jackson Hole, and I'm going to paraphrase Powell here a little bit. He said the process still has a long way to go. And there have been 2 months of lower readings, right? 2 months of core, if we look at core PCE, 2 months where they've felt like things are moving in the right direction, but 2 months do not a victory make. Yeah. And he made that very clear as well. The other thing that I think was the biggest takeaway that people were sort of speculating he might do was inch towards the idea that 2% is no longer the target. He did not do that. In fact, I think a couple different times he reiterated, we have no intention of moving away from this 2% target, which I'm glad he did. I know Guy and I have talked about that a few times over the last few weeks, that if they started to indicate 2% would no longer be the target, I think the interpretation of that is we no longer have the tools and we don't have control over it. So I'm glad that he reiterated that. The market swung pretty wildly. In fact, so wildly that I tweeted about it being down. And as soon as I tweeted about it being down, it went back up and it ended the day positive. So it swung pretty wildly. I think what people were expecting, I know what people were expecting because there were surveys about it, was a hawkish message, and a hawkish message they got, right?
Yep.
So then the reaction was sort of, okay, what's the digestion of rates higher for longer? But I don't think there were any big surprises. In fact, I think a dovish message would have been worse.
I think he continues to do what he needs to do. They all listen again for the thousandth time. I'm no fan, but I will say I think Jerome Powell for the last year and a half, 2 years, at least since it's actually coming up on 2 years, which is amazing. November of 2021 is when they indicated they were going to start to move the other way in terms of interest rates and in terms of their balance sheet. I think he's done a really good job telling the story and sticking to his guns. Now, the problem obviously I have is not necessarily with him, but the market's interpretation. Now, technically, I guess, Dan, the fact that we traded down to about 43.50-ish in the S&P last week, again, that level was the prior high we made back in August of last year. So past resistance becomes support. We bounced off it. I guess it makes sense. I'm surprised by, again, the indicated strength this morning, but we'll let this sort of play itself out. Vexed? Are they vexed? I don't think the central bankers are vexed. I think the market is vexed by this lag effect that I heard a lot of people talking about over the weekend as well. And it's interesting. Some of the people that they interviewed talk about their inability or the fact that they were misguided in their judgment of how much liquidity was still sloshing around the system. And that's probably adding to and making this lag effect last a little bit longer than a lot of people, including myself, thought. But it doesn't mean it's not going to happen. And I think to a certain extent, we're seeing it around the edges. Again, what's interesting is these move in the bond markets. Now, again, you have 2 years significantly above 5%, that 10-year sticky around 4.25%. The inversion, which steepened to 60-something basis points, looks like it's, I don't know, as I'm looking at it this morning, probably in the 80s, 82, 83. I don't think I don't think the market knows what to do with interest rates in the bond market right now, which means almost by definition, I'm sort of puzzled myself, Liz.
All right. So interestingly, you mentioned that 2 year above 5%. Liz, when you think about just some of the issues that caused, I think the last bout of fear in equity investors, back in March, is this regional banking crisis. SVB went down, a few others went down here, and you think about just kind of how banks have acted over the last large money centers. Bank of America went from right before its earnings, I think about 28 or so dollars up to $33, and here we are now. It's kind of round trip that whole move, and to me, the way a lot of large banks act right now tells you that with rates going higher here, these held to maturity mark to market losses that they might have here are going to be kind of difficult. And the Fed signaling higher for longer just does the same thing, right? Where a lot of investors or a lot of people are going to start thinking about where they can get the best yield on their cash. Are we going to see, when we get into October and we get into Q3 earnings, are we going to see deposits going for higher yield? And are we going to see some of these banks having some big problems? Because I think the large money centers, were meant to be the big recipients, I guess, of the regional banking and the capital flight and the ones that went under.
Well, but I think that already happened. Yeah. The deposits already moved and people already took their money out of regular bank accounts, put it into money markets. Everybody caught that trend, right? Even investors that are not involved in the markets like we are started to figure out what a money market fund was and realize that it was paying a lot of money, or try to figure out how do you buy a treasury bond, right? There's people that own treasury bonds that probably never expected to do such a thing. But I think you hit it on the head. When you look at the way that financials have traded, first of all, poorly, right? Pretty poorly. Mm-hmm. Banks in particular, over the last month or so, and in particular during the time when the market was pulling back. I've talked about this a couple times. I don't think that this recent pullback was fear-induced. I don't think there was a catalyst that made people afraid that the market was going to go down or that something terrible was going to happen. I think it was much more valuation-based and trying to right-size some of the multiples and understanding that, okay, we got overextended. Even the bulls thought we got overextended. So some of it was just giving back the run-up that had occurred. But the interesting part about financials was they weren't overvalued when this started. Mm-hmm. And they became even less so as this went on. When you think about, number one, higher rates for longer, you hit it on the head with the mark-to-market issues, right? They've only gotten worse, really, since March. And as rates go up and stay up, they will continue to get worse. But then there's this other side of it, which you'll hear as the optimistic side of banks, which is, okay, if the yield curve re-steepens and comes out of inversion, that's actually good for financials. Yes, it is. I completely agree with that, but we've got a long way to go. And to Guy's point, I think we're 86 basis points inverted now today.
Amazing.
To get from 86 to zero isn't where it's good for financials. You need it to be positively sloping. So there's a long path between here and there that I think is going to still be painful for a lot of sectors.
Guy, you spent some time last week on the pod talking about the bear steepening. How do we get back to like a zero, right? And how does that happen? Okay, like for instance, because we're going to talk about China in a second, and it really seems like the deflationary readings there and all the stimulus that they're trying to do to prop up the property sector, the stock market, and the like here, it's not working, at least through the transmission mechanism of the markets, right? And so one of the stories I caught over Bloomberg this morning, this one is interesting. China's worsening economic slowdown is rippling across the globe here. So how does this inverted 210 get back to even, and what does it mean for risk assets?
So I have the math for that. I think at a certain point, 2-year yields will get anchored at a certain level, and it's probably, and I'm spitballing here, Elizabeth probably knows better than I do, but my sense is 5.25 ish sort of maxes this out, I think, in terms of where the 2-year goes. Now, here's the problem. I also think is that in order for it to get to zero, to get to flat, you're obviously going to need 10-year yields to move higher in a meaningful way. So the next question is, how does that happen? Well, I don't think it's going to happen on the back of economic growth. So you don't have that working for you. What I think it's going to wind up happening is inflation is still a problem. And oh, by the way, the ECB is still struggling over there in terms of what they should do, whether they should fight inflation, which is a bigger problem there than it is here, or try to help their economy, which is clearly in a slowdown. But coming back to here real quick, I think rates can go higher just on a supply and demand thing. And then the people's want and demand for higher yields to continue to buy our debt. And again, if what's happening in Japan is what I think is happening, I think they will continue to probably be a seller of our treasuries. You have to ask yourself who the incremental buyer is. And that incremental buyer is going to demand a higher yield to purchase our debt, which should theoretically drive bond yields higher. And under those set of circumstances, again, I think it's not particularly favorable for other risk assets like stocks.
Yeah, one of the other inversions that we don't talk about very often, I know we kind of obsess over this 2s, 10s inversion. There's something called the near-term forward spread. I think I've probably mentioned it before. This is what the Fed watches. The near-term forward spread is the 3-month yield today versus the 3-month yield 18 months from now, or the market's expectation for the 3-month yield 18 months from now. It originally inverted back in November of 2022. It has stayed inverted ever since. It sniffed on inversion in March, but never really made it above. So now it's re-steepened a bit, but it's still inverted about 82 basis points. That is something that the Fed is going to watch. I know they're watching. It's something that they use to predict whether or not there's a recession on the horizon. So they know, whether they say it out loud or not, they know that a recession is possible, and maybe more possible than it was before. This is something that, as this part comes uninverted, and I think this will probably re-steepen faster than the 2s, 10s, but this will inflict pain as well. And if you look at just what's happened, even over the last 4 months, since May or so, it's re-steepened pretty steadily. And over the last month or so, it's re-steepened more quickly. I don't think it's any coincidence that stocks have felt the pain of that, because what's happening is the market starts to expect that we're going to see cuts within the next 18 months. And the reason for those cuts, as we've pointed out many times, probably not going to be good. I think it's probably a fantasy to assume that the Fed's going to be able to just slowly unwind this, slowly come down to neutral. And now we don't even really know what neutral is.
Yeah, no, we don't. But, it's interesting that, the stock market is you talked about the volatility during this speech on Friday, Summer Friday, one of the last ones, that we got here, and probably, liquidity pretty weak. But the fact that we're like up 50 basis points right now in the S&P 500 is just kind of funny, this higher for longer rate, it's sooner or later, it doesn't jive with equity valuations where they are, and so, a lot of us, on this pod over the last year or so, we've been talking about valuation almost foolishly in hindsight because it really hasn't mattered, but I guess the point that we've made on many occasions is that when the Fed did signal that they're going to raise rates to battle inflation in late 2021, I mean, the hardest hit stuff was the highest valuation stuff, the stuff that had no earnings support, and the like. So I just feel like at some point we have to have that sort of, and maybe it's into Q3 earnings as we get into October or so, but that has to happen. And, I think that when we talk about some of these big, the mega cap names and just how they've cooled off over the last month and a half or so, really since mid-July, and you look at NVIDIA's reaction to open up 10% after its earnings, which was just gangbusters. We all knew it was going to be, but the fact that that is sold off 10% from those highs, it tells me that we might be in for that, coming this fall, especially if guys, two-year yield gets anchored at 5.25, and then we start seeing a weakening 10-year based on growth, based on what's going on in China. And I want to kind of segue here to this. The Commerce Secretary, Gina Raimondo, over in China, and talking about, just U.S. And Chinese trade. And here was a quote from a Bloomberg article. We'll put those all in the show notes. She's stressing the importance of strong economic ties between the world's two biggest economies, and just saying that this is all, a lot of the trade policy is not about national security, which we know is not exactly the case here. And, it's funny, Guy, as you would say, this woman is a bit of a badass. She was the first woman to go to the LaSalle Academy. It was an all-boys Catholic school. Okay. She went and graduated from Harvard College, magna cum laude. She was the first governor of Rhode Island, and often thought to be like a really centrist Democrat, you know what I mean? And, she was, I think, considered for a whole host of posts in the Biden administration. And I just wonder, as the debate about Biden, the debate about the vice president, how they shore up this ticket. And, I wonder if she's being elevated a little bit, because her going over to China right now, this is a pretty tense time. We spent a lot of time talking about what could happen as far as boycotts and just, a whole host of economic sanctions if the Chinese were to do something with Taiwan. But this is a very high profile visit, Guy.
Yeah, and I'm correcting you only to make a joke. If she were the first governor of Rhode Island, she'd be old as shit. So I think she's probably the first female governor
of Rhode Island. Okay. Jacob was going to edit that, Guy, and now we got this.
Well, now he doesn't have to.
Yeah.
I think this is the fourth person that we've trotted out there, and it's all sort of folly if you think about it. Janet Yellen, Blinken was out there, she's out there, somebody else whose name escapes me. Oh, I think John Kerry was out there as well. So, we continue to do that because our reliance upon the relationship we have with the Chinese. I totally get it, but one thinks by definition that's going to make the Chinese acquiesce, and I don't think that's going to happen. And as their economy continues to sort of slow down, and they find themselves in the situation that they find themselves in, I think the likelihood of something bad happening is greater, not lesser. When you back somebody into a corner, it's typically when they fight the hardest, and I think that's might be happening with the Chinese. So maybe we'll get some sort of couple-day détente in terms of the rhetoric, but it's not going away. And I still think the reason why you see so many people go over there is because our relations with the Chinese are probably the worst they've been in decades. In terms of her status, I don't disagree with you, and we obviously don't want to get into the politics of this whole thing, but it's clear that I think the party is trying to elevate certain people as sort of a dress rehearsal for, I don't know, I don't want to say inevitabilities, but potential different outcomes in the spring of next year.
Yeah. So, Liz, what he's talking about, you're watching the Diplomat on the Netflix, Felicity.
I'm really bad at TV.
Oh, really? Without any spoilers. I mean, here's a woman who's kind of been, a little dress rehearsal for a VP slot guy. Is that what you're kind of going to?
Listen, I put it out there, and I put the ball on the tee. And then, by the way, speaking of balls on the tee, the Yankees could really use a couple balls on the tee because holy shit.
Oh, man.
I could go. I mean, you hear old dudes say this all that. It's funny because when I was a kid, the old men was, I could hit shit. The guy's hitting 180. I could do that, which is dumb. And now I find myself doing
a little bit.
You're one of the old guys. Yeah. Look, first of all, when you think about what's happening next year, we're going to talk about an election
Yeah.
all year ad nauseum,
We're talking
right?
about it now all
Right. Well,
year.
and
Ugh.
just think once the nominations go, but
Yeah.
leading up to the
Yeah.
nominations, I'm tired already of talking about it. That's going to change things. It's going to change or at least put things on pause, right? Maybe China waits for the next person to come into office,
Yeah.
but I'm guessing that if this tension stays as it is, and I'll paraphrase Guy, if tensions are as high as they've been or our relationship has been as bad as it's ever been, then the next person in the White House is going to matter to China. And they might wait. They might push
Yeah.
things off until that occurs. But it all is this lead up to what's going to happen next fall. And the other thing is, we're going to talk about the yield curve. We're going to talk about the Fed. We're going to talk about earnings for the rest of this year. The reality is, once we get into spring-ish of next year, there's not much else that's going to matter besides what's happening in the election. And we're going to talk about Democrats and Republicans in the White House and how that affects the market.
Yeah.
And spoiler alert, it doesn't. But either way, the tide is going to shift. The topics of conversation are going to change. And I think what happens this fall in the economy and in the market is going to matter a lot for who makes it into the nominations next spring.
Yeah, and I think part of this is also this idea of deglobalization, and so it's interesting that one of her remarks is like it was not, like some of the tensions are not a matter of national security as it relates to economics, and that's clearly not the case because when you think about this, there's an article in Bloomberg this morning: Apple's iPhone supply chain splinters under U.S.-China tensions, and we think about just kind of like a lot of these U.S. multinationals who relied on China for cheap manufacturing, they've oriented their supply chains there, and then they become reliant on their consumers to buy their products, right? And so you've had this rising middle class, and you think about what's going on. I mean, the Chinese have been building these ghost cities, trying to get people out of the farms into the cities for manufacturing, and now it's going the other way. And this article is really interesting. It was done in 2012. No Apple-related suppliers operated out of India. Now the country is home to 14 of them. So it says the new iPhone 15 will be the first model to ship directly from India just weeks after it starts leaving factories in China. And I think this is really interesting because the main point is that if you have to reorient your supply chains, if you have to make new factories, if you go to places where, let's say, labor is not as cheap, that's inflationary. I mean, or it's a hit to U.S. multinationals, to their earnings. If you think about Apple, that has a 40-some%, gross margin, they literally have 90% of the gross margin in the entire smartphone business. Think about that.
Mm-hmm.
A lot of their competitors don't make really any money on their hardware, right? And they do because they've been able, Tim Cook, this is his, opus, I guess, what he was able to create in China over the last 20 years. And so I don't know if that's going away. I mean, there's a lot of inflationary aspects of that, and they could also weigh on U.S. corporate earnings. All right, guys, before we get out of here, we're not done with earnings yet. And I think some of the volatility that we saw around some of these retailers, we saw that move out of Dick's. There was a whole host of names that just really were eye-popping if you thought of the way that they were kind of, baby with the bathwater. We have Best Buy, Guy, tomorrow, Tuesday, pre-opening. This stock had a big move off of its lows. I think maybe people are getting all geeked up about back to school. It's given a lot of that back over the last couple of weeks, so it's down in sympathy with a lot of these. Later in the week, we're going to have Lululemon. This one's kind of interesting because it's more of a higher end. Just by the way, when I saw Liz, she was decked out in Lulu, like head to toe. I mean, like literally.
And a Yankees hat.
Keeping that place afloat here. Guy, talk to us about what we might see. And also Dollar Gen, which I know Dollar Tree, that was not particularly great. It seems like, we came into earnings season in mid-July with, some enthusiasm about what the banks had to say. We are limping out of it with the mega cap techs in, not acting particularly great, and then retail very disappointing.
All right, so let's look at Best Buy real quick. The all-time high, again, like many stocks, was the fall of 2021, I think in November to be exact. And I think the stock was north of 140. It's been cut in half since. So here are your levels. I think the October low of last year was about $61 or so. That is support. You're in this downtrend from the aforementioned November level. To your point, Dan, we traded up recently and failed. The high in February is about 90. So you keep making lower highs. The last high was, I think, about 83 or so. That's not particularly good. And you're in this little bit of a pennant formation. I think in terms of trading the stock, let the price be your guide. I happen to think it's probably going to test that 61 level, and I think you take a shot there. Other people think, we've sold off enough where you can play for the breakout to the upside. I am not one of those people. In terms of what it means for the consumer, I'm not necessarily sure. And, I think the consumer behavior and the patterns of the consumer are changing right before our very eyes. And there was a time where Best Buy obviously won to all of this. I don't necessarily think they do in this environment, Dan.
Liz, retailers, what's your takeaway?
Well, first of all, just anecdotally, I think it's funny that people do back to school shopping at Best Buy today, because when I did back to school shopping, it was like at Kmart and then
notebooks
Office Max.
and
And now back to school
pencils
shopping is tablets and
the kids
everything
today.
electronic. Spoiled. Anyway, retailers. So I think retailers, number one, are still probably benefiting from the fact that consumers are still spending. But the interesting part is that retail stocks have not traded very well, even in the face of consumer sentiment and consumer confidence that has gone up and seen a big rebound on the heels of cooling inflation and a higher stock market. So the market is sniffing something out in retail and saying, much like I think is what's happening in banks, sniffing something out and saying, this is at risk, right? This is at risk for a change in direction. This is something that, and particularly retailers, can change on a dime. Mm-hmm. Consumer confidence, as we've seen, has reversed directions very, very easily. It can go the other way, again, very, very easily. As long as the labor market is strong, consumers will spend money. Retail stocks can probably chug along. But also remember what we're doing here. Some of those retailers, yes, back to school is a big tailwind usually. Now we've got this kind of pause, but then come end of October, we're going to start talking about holiday spending. Guy, I will not exercise you today with what happens when the big man comes in December to the stock market. But we're going to start talking about that.
Don't listen. Can I just, I don't mean to stop you, but if I hear the term, I can't even utter it myself, but the big man rally, that's going to be.
But you're going to, you're going to.
Well,
it's funny. There's certain anchors that just love that stuff. They can't help themselves. Happy Hump Day, Santa Claus rally.
Melissa likes to do that right after
she does it
Halloween.
Just to piss
guy
she just
really right after Halloween. All right,
that's what I mean. Come November, we're going to start talking about that. And it's not so much, I think, this year about the absolute level of spending that will happen. It's going to be about the relative level of spending. Have consumers pulled back despite stronger economic data, despite what's happened with inflation? And have companies now suffered because inflation is lower, so revenue is lower?
Yeah,
we're going to find out.
And then we have the student loan repayment starting in October, and that I think is going to be a real curveball. Last thing, and I'll just round this out here. So Salesforce reports Wednesday after the close, and this one is really interesting to me also because we talked about that July 18th and 19th when a lot of the mega cap stocks Microsoft announced their Copilot, AI pricing tools, and the stock rallied sharply, and then has really since sold off pretty dramatically over the last month and a half or so. Salesforce was also one of those names, introduced some products and some pricing that week, and it's down about 10% from those levels. It's broken the uptrend. The stock was trading at $125 at the end of last year. It got as high as $240 or so in mid to late July, and then had that reversal. So technically, it's broken. We know this is expensive stock, and really, if there's just any hiccups in this one, Guy, this thing is going to be on its way back to that 200-day moving average down there at 185, in my opinion.
Which, and valuation is going to be, valuation for the stock was not a concern when valuations didn't matter at all. And again, as I mentioned earlier, it's not coincidental that that Salesforce CRM made its all-time high, like many stocks, in November of 2021. And to your point, Dan, that stock went from north of 310, I think, down to that sort of 125 level in a very precipitous way. The bounce has been decent, obviously, since December, but now, unfortunately, it got itself expensive, I think, again. You can make a case for this stock on valuation all through the fall of 2022, earlier this year. I don't think you can make the same case now, especially with interest rates where they are.
Yeah, so this is one I think that's going to be really important on what could be a quiet week in the stock market. All right, EY from SoFi, you guys like to say get your money right all in one app. You can get all your trading right all in one podcast right here on the tape. You see what I did there, Guy? Guy Adami, bright and early. And we have a really fun sort of thing going on today. We're going to find our way up at the Sirius XM SR studio. Liz is going to be our guest in studio. That's market call 844-942-7866. Every Monday at noon, you can call in. You can pick our brains. Liz is going to be there with us today on Monday. You're probably going to be listening to this after that, but just as a little reminder, we do that every Monday, and hopefully Liz will join us more. And then also stick around for my conversation with Chad Anderson of Space Capital, the author of The Space Economy. Get your free book by leaving reviews for these podcasts, and then email a screenshot to contact@riskversal.com. So thanks a lot, everybody. Stick around for my conversation with Chad.